Why markets rallied today? Both the Nifty 50 and Bank Nifty indices witnessed positive trends on Jan 31st, offering welcome news after recent downturn. Let's dive deep into the details of the key drivers and factors behind the performance. The Nifty 50 closed at 17,706 points, which was up by 159 points from its previous close, marked a steady climb throughout the day. The positive sentiment, sectoral gains, and F&O expiry are the key drivers of Nifty today. Improved investor sentiment across sectors, driven by factors like easing concerns over US rate hikes and optimism about upcoming corporate earnings, fueled the upward momentum. Strong performance in sectors like IT, pharma, and FMCG aided the Nifty's rise. Infosys stellar quarterly results proved a significant boost. Expiry of January F&O contracts potentially led to some short covering and squaring of positions, contributing to the positive momentum. When coming to Bank Nifty, Nifty Bank was closed at 45,442 points, which was 576 points up by previous close. This impressive surge followed 3 consecutive days of decline. The key drivers are spillover effect, earnings optimism, and short covering. The positive sentiment from Nifty 50 spilled over the banking sector, boosting its performance. Positive earnings reports from other leading banks like Kotak Mahindra and HDFC Bank instilled investor confidence and triggered buying interest. Similar to the Nifty, short covering in banking stocks likely played a role in the upward trajectory. When coming to the other factors that helped Nifty and Bank Nifty, upbeat global markets played a crucial role, particularly rising European indices further fueled the positive sentiment in both indices. Continued stability in oil prices provided some relief to investor concerns about inflation and potential rate hikes. The rupee's slight appreciation against the US dollar offered additional support to the market. The market action can be attributed to a confluence of factors that worked in favor of both Nifty 50 and Bank Nifty. Improved sentiment, strong sectoral performance, earnings optimism, and short covering were the key drivers. However, it's important to acknowledge that the market remains sensitive to global clues and domestic economic data, and the positive trend may not necessarily be sustained in the long term. Now, as we are moving to the stock updates, before going to that, we have an interesting update regarding the Union Budget 2024, which was going to be released tomorrow, that is February 1st of this year, by our Finance Minister Nirmala Sitharaman. We have an update from Confederation of India Industry. Confederation of India Industry made some pre-budget recommendations for the upcoming budget in 2024. The CII has suggested the government should adhere to a 5.9% fiscal target for this year and aim for further consolidation to around 5.4% for financial year 25. Let's dive into the details behind the recommendations of CII. The CII emphasizes the importance of achieving the fiscal targets set for Budget 2024. They suggest that specific measures need to be implemented to create space for growth, both in terms of augmenting revenue and rationalizing expenditure. The industry chamber believes that achieving these targets will pave the way for sustainable economic development. To boost revenue, the CII proposes the simplification and rationalization of taxes. One key suggestion is to implement the next set of GST reforms by reducing tax slabs to 3 and subsuming petroleum, electricity, and real estate under the GST framework. The CII has also recommended an aggressive focus on meeting disinvestment targets, incorporating demand-side considerations, and creating a 3-year schedule for disinvestment. Chandrajit Banerjee, Director General of CII, suggests a roadmap of simplifying tax deducted at source, that is TDS rates. The proposal is to have only 2 or 3 categories of payments and a small negative list of payments not liable to TDS. Currently, there are 31 sections dealing with different types of payments, leading to complex provisions with varying TDS rates. CII highlights the need for rationalizing expenditures, particularly in food and fertilizer subsidies. They recommend better targeting and efficient utilization to avoid impacting deserving beneficiaries. The CII also suggested using more current data for the food subsidy program and moving towards dispensing fertilizer subsidy directly as cash transfers to farmers. These proposed measures, if implemented, could create room for the government to support sustainable growth by increasing capital expenditure by 20%, that is 12 lakh crore rupees. CII points out that while this represents a moderation from the growth in the last 2 years, it compares well with the pre-pandemic period's 12% growth from 2015-16 to 2019-20. On the investment side, CII recommends establishing a Ministry of Investment as a single point of contact to facilitate opportunities for both domestic and foreign investors. In conclusion, the CII's pre-budget recommendation aim at achieving fiscal targets, boosting revenue, rationalizing expenditure, and fostering economic growth. These sessions provide an insightful perspective of the economic priorities for Union Budget 2024. Now we will be discussing about the two important stock updates from Larsen Toubro and NTPC. Before going to that, like this video and subscribe to our channel Financial Radio. As we discuss the first update from Larsen Toubro, a construction and engineering company, it is facing a drop in its share price. The shares fell 7% because their Q3 earning didn't meet expectations. This is the second day of decline in 2024. Right now, L&T shares are at near 3,490, down by 3.9%, and the company's overall value is 4.8 lakh crore. In the last session, the stock hit its highest point in a year, that is 3,738.90 rupees, bouncing back 80% from its lowest point last year. In Q3, L&T made a profit of 2,947 crore rupees, a 15% increase from last year. The total earnings from Q3 financial year 24 were 55,128 crore rupees, with almost half of it coming from international businesses. Despite global challenges, S.N. Subramaniam, the chairman of L&T, is hopeful. L&T is now making into chips and focusing on new age stuff like digital platforms and green energy. They got orders worth 75,990 crores in Q3, a 25% increase from last year. Overall, in the past 9 months, they got orders worth 2.3 lakh crores, growing by 49%. Experts expected a profit of 3,400 crore rupees and a revenue of 54,100 crore for Q3. Even though L&T didn't meet the expectations, foreign experts are still saying buy with different price targets. In the end, while L&T is facing some short-term issues, most experts believe it will grow in the medium term. Now, as we discuss the second update from NTPC, the government gave thumbs up for NTPC, a big power company, to let people buy shares in its green energy part called NTPC Green Energy Limited, which is called as NGEL. They are aiming to collect around 10,000 crores to help with their big plans for clean energy projects like solar and green hydrogen. Our sources says NGEL might go public, meaning people can buy its shares after March. This approval from the government, called DAPAM, is a big deal for NTPC's dream of a greener future. The plan is to use the money from selling shares to hit a goal of adding 60 gigawatts of renewable energy by 2030. NTPC and NGEL want to hit that 60 gigawatt goal even earlier than 2030. Gurjit Singh, the boss at NTPC, is feeling positive about reaching that target sooner, especially with the growing demand for power. NGEL is all about green energy and is owned completely by NTPC. Right now, they are already running with over 3.4 gigawatts of power and have plans for 26 gigawatts, with 7 gigawatts currently being worked on. They are into solar and green hydrogen, following the trend towards cleaner and more eco-friendly energy. In recent news, NGEL teamed up with Maharashtra government. They signed an agreement to work on green hydrogen projects in the state, investing around 80,000 crore rupees. This includes projects for green hydrogen, green ammonia, green methanol, pump hydro projects of 2 gigawatts, and renewable energy projects of 5 gigawatts in Maharashtra. To sum it up, NTPC wants to sell shares of NGEL to get funds for their green energy goals, making a positive impact on India's move towards more renewable energy. This share sale is likely to catch the attention of people who want to support a cleaner and greener future. That's all we have for today. If you really like this video at any point of time, don't forget to like this video and also subscribe to the channel Financial Radio.